Hello and welcome to this roundtable discussion, Asia in Focus, thriving in an evolving and competitive landscape. I'm John Watkins, Managing Editor of Global Custodian, and I'm delighted to be here in Singapore, joined by this esteemed lineup of panellists, all whose businesses seem to be both thriving and evolving. Now we're here to discuss how the most exciting, innovative and rapidly changing region amongst the world's capital markets is impacting asset services, who are obviously benefiting from this vast range of opportunities, but themselves have to keep pace with progress and adapt and evolve accordingly. So joining me today we have Siraz Mohammed Musa, Global Head of Buy-Side Custody Products and Solutions at BNP Paribas Security Services, Phil Van Dine, APAC Head of Banks and Market Infrastructure Sales and Client Coverage at Citi, and Francois Verlaine, Managing Director and Head of ASEAN and Southeast Asia for the Financing and Security Services Division at Standard Chartered. Welcome all.
Thank you.
Thank you. Looking forward to this. Now, I feel like so much has been made of, said and written about this seemingly everlasting purple patch of growth within Asia's capital markets, an era of wealth and investment in the region. But what has this meant for the competitive landscape for asset servicing providers? Phil, why don't we start with you, and I'd love to ask how you have seen this landscape evolve over the years and how you think the changes might occur in the future.
I want to highlight something that's occurring within our industry as a whole. We're seeing quite a lot of change across the board. I mean, we're talking about things like settlement compression, its impact on investments, operations. We talk about technology, the need to invest significant dollars to cope with, say, digital assets or even AI. So from my perspective, what we're seeing, or what we've seen certainly across the European landscape and likely to eventually see into the Asia landscape, is some level of consolidation, because when you're trying to keep up with regulatory change, trying to keep up with technology change and all of that investment, it gets very difficult to remain commercially viable to support all the various investment aspects that are going on. But secondly is, because of this change, the post-trade space has become very interesting, right? I mean, 5-7 years ago, this wouldn't have been the area for someone to come out of university and then make their move into this space. Certainly now, I think there's a real opportunity here for people to come in, make a dramatic impact, because we're seeing significant opportunities and change occurring within our space.
I mean, that's an interesting one. When I think of the competitive nature of our business, and I agree with everything you said, and it's a super exciting time to be in this business. And yet, nothing's really changed over the last 10 years.
Really?
Right? If I think of the number of custodians that operate in Asia, let's take those who act as sub-custodians or domestic custodians. We have 4 or 5 foreign players who service that area, plus a bunch of local providers. The reality is, in many markets, including India, Indonesia, China, Taiwan, Korea, there's more than 20 custodians that operate in that market. Now, when we talk about scale and size and investment, you'd think, what's going on there? That we have this situation. Even in Indonesia, look at the last 3 years, there's actually been 6 new custodian licenses which have been granted. So in that sense, from a competitive environment, it hasn't changed a whole much. That said, coming back to your point, that's referring to traditional assets. I think when we look at private assets, that's very different, and you get new players coming in, such like the SS&Cs, the Eltedammers, and the non-traditional custodian players. And then if we look further, I guess, on the innovation side, digital assets, that's a much broader ecosystem and a whole different ballgame. So on the traditional side, in my mind, not a huge amount of change, but in some of the other asset classes, absolutely.
It's interesting, Francois, because it's true that one could have imagined when we started talking about DLT, about new tools available, we would have eventually think that the complete market infrastructure, the way we are operating, the way we are maneuvering, with the way we are servicing clients might be completely transformational. Now it's fair to say that we have not observed that yet. What will be interesting is what is ahead of us, and I'm sure that we'll be picking up a number of those items. But one thing that is clear, it's change has been constant. Now the pace of the change eventually has changed. And what we are observing, at least so far, is the intensity. I believe that when you look at a number of, I will say, drivers behind that, of course, we look at the global economic environment, interest rate, swinging returns. So of course, new asset class will come in the picture, and I'm sure that we will be deep diving on that. Geopolitical context. Again, what does that mean from a risk management framework, and how can we leverage on new tools to be more stronger and more disciplined? But at the same time, regulatory landscape, I believe it's constantly evolving, and we need, as a bank, and all the three of us, have to comply with. So definitely, I will say, adding to that technology, and this is just a massive avenue for transformation. I believe that more and more clients, what they are expecting, it's not anymore the pure core asset servicing. What they want is to go beyond. What they want is multi-solution. It's really to provide beyond asset servicing. How can we do better? How can we do right? How can we do good?
I guess my point earlier was I'm surprised it hasn't happened faster.
Yeah. And it's interesting, like you say, all these new licenses popping up and new players are entering the market. It's just not the same. You're not on that, maybe it's a different point on that trajectory than some other markets are in. Like you say, Europe, think of Australia as well, very similar trends over there. Yeah, really interesting. Obviously, what I'm taking from the early comments is we have three similar yet also very different providers here, but also the same with the markets we're talking about as well. Some emerging, some very developed. Francois, could I ask you, we've discussed this providers landscape and we're going to get to some client trends in a minute, as Suraj mentioned, but has there been an impact in the kind of the fallout of the political situation globally at the moment? And how has that impacted the capital flows we're seeing either from or into Asia? And we're recording this at the end of May, just to put a timestamp on it in case it's outdated.
Good that you put a time frame there. It depends on what tweet's going to come out next. Look, I see it, I divide it into three different areas. One is around growth of wealth within Asia. Mm-hmm. One is around investment into Asia from abroad. And the third one is investments from Asia outbound.
Yeah.
Right? So when we think about the first one, which is growth of wealth in Asia, we've seen tremendous growth, right? And GDP growth across the markets. There's a handful of markets that have more than 6% growth per annum, and the rest are typically more than 4% GDP growth per annum. Half of all high net worth individuals globally will come from Asia between 2025 and 2028. There's going to be 40 trillion of high net worth wealth in Asia at the end of 2025. So we're talking about a huge amount of money. In addition to this, there's a huge increase in middle class, and therefore that retail participation is on the up. So what does that mean for our business? It means, look, there's going to be increased insurance needs, asset management needs, or investment needs, and the ability to be able to service the retail side. So that touches on the first item, which is around growth within Asia, which has been quite tremendous, even though it may not be reflected in the markets itself. The second one is around investment flows into Asia. And that's where we start seeing quite a big difference as a result of the current geopolitical situation. Mm-hmm. Let's take two countries as an example, India. So FPI flows into India, so foreign portfolio investment flows into India, have actually stayed pretty consistent over the past even 9 months. Right? So we haven't seen, there's been a small dip of 3%, but the reality is the Indian markets have fallen. So the fact that foreign portfolio investment has only gone down by 3% is actually quite a positive take. The China story is very different. And I don't have numbers for the foreign FPI numbers into China, but FDI, so foreign direct investment, has fallen off a cliff since 2021. Right? It's now at around 5 billion. It was at around 450 billion. And that's a reflection of the current situation, right?
Yeah.
Investors looking to pull money out, pulling their profit out of China, the reluctance to go into China. That has a big impact in China. And as a result on employment, on growth, and so forth. If we look at the last piece, which is investments from Asia outbound, the reality is China is the biggest player there. Now, China outbound investment has actually stayed pretty stable. The big difference is that gone out of developed markets and into emerging markets, right? So out of not just the US, but Europe, into Africa, into ASEAN, and into Latin America.
Yeah.
So that when we think about asset servicing, we need to follow those trends, understand the implications of that, and how we're able to serve those assets.
Yeah, that's really interesting, because when we were speaking previously about, okay, what's the biggest impact, and you mentioned this, and Suraz and Phil, do you see this as a major impact on you as asset services that, again, perhaps wasn't top of my list, but is obviously important?
So I think you had some really interesting points around that retail wealth growth in middle class, as well as the impact of India and China. So if I could just take a moment, right? So let's take India as an example, this rise of wealth and rise of middle class there. So of the 1.4 billion people in India, 900 million are of working age. 990 million. 600 million of that is under 30. So think about that working class growth that's going to happen from an investment perspective. And India is still very much a domestic market. So we're seeing that. That's not so different than what we've seen in Brazil, not so different than what we've seen over the years with Indonesia and Malaysia, with the rise of the middle class that's going there. The other thing is, India wasn't so impacted from the tariffs because when you look at the import-export between the U.S. and India, it's actually relatively low, and it's no wonder that it was one of the first ones to go ahead and get negotiated, right? But going back to China, there is a dramatic impact there. Now, China has a couple of things going for it. If you look at the first time the U.S. administration went through this, you saw China's influence, specifically in the Asia region, grow immensely, right? Manufacturing, Vietnam, Thailand, Siam, they all came up, right? And what we're likely to see again is, this is going on, but private equity markets might be a little down, but that's a lot because the U.S. investment into China is a bit curtailed, if you will. But the rest of the region, and what they're looking at is China is still a very much dominant player here. There's still a lot of investment, and you talked about both the One Belt Road and everything else that's going down. Those things are long-term play that we're going to continue seeing those investments into the region. Now, when you marry that with the population rise and the middle class, Asia is still going to be very dynamic from a market to consider for years to come. I mean, these, to a degree, you can go, these are blips along the road, but if you're a long-term investor, you're certainly going to continue to look at Asia.
No, I completely echo that. Couple of elements. I believe that, again, in terms of cross-border flows, definitely from east to west to east, definitely we are observing that. Completely agree with you, Francois. I guess the research for the yield, also now investors, institutional investors, are moving into more emerging frontier market. That's very clear. You highlighted, I would say, the wealth industry. Probably one also to quote is the pension fund industry. Because again, when you look at Australia with the mandatory, I would say, scheme that they have, specifically the superannuation fund, this is just growing massively, similar to Malaysia. And what is interesting in terms of, again, investment behavior, and we quoted that in the beginning, clearly we can see a complete shift and more, I will say, weighted in terms of asset allocation to private market. This is definitely another way of decorrelating the listed stock market, I will say, pricing swing versus more longer term. Definitely, I will say, more for, I will say, accredited investors, but a huge amount is floating there. And as an asset servicer, we need to be able to cope with that. So clearly, in terms of asset classes, in terms of flow, in terms of investment amount, but also a flight for quality, specifically now with credit rating going down in a number of markets, I guess that the AAA countries will definitely benefit from cash in.